Welcome to the Daily Insights That Matter. Now, in its latest monetary policy review, the RBI has done two things. One, it has raised the repo rate by 35 basis points. The repo rate, as we know it, is the rate at which the RBI lends money to the banks. Second, it has cut India's GDP growth forecast for the current financial year, which is from April 2022 to March 2023, from 7% to 6.8%. At its current level of 6.25%, the repo rate is at its highest since Feb 2019. And so far in calendar year 2022, the MPC has raised the repo rate by 225 basis points. Now, the committee also retained its inflation forecast for the current financial year at 6.7%. Now, the retail inflation seems to be cooling off, even though it is still above the RBI's upper tolerance level of 6%. The CPI inflation, or the retail inflation, stood at 6.77% for the month of October from 7.41% as seen in September. The RBI also expected inflation to stay above 4% for the next 12 months. Now, while domestic recovery has been seen in high-frequency data like bank credit growth, PMI services, manufacturing expansion, rising GST collections, etc., risks emanate from global economic outlook, which continues to remain bleak. Hence, the RBI has trimmed down the GDP growth forecast to 6.8% as against the initial forecast of 7%. Now, the moderation in the rate hike from 350 basis point hikes earlier was largely on the expected lines, given that the inflation is above its targeted zone. Now, even as inflation still remains above the upper tolerance of RBI of 6%, the retail inflation in India has slowed to a 3-month low of 6.77%. Now, the general consensus is that the inflation has peaked and is expected to moderate going forward. Now, the lowering of the full-year GDP growth forecast is largely to factor in the impact of the continued global headwinds, which will impact India's GDP growth. Now, taming inflation and ensuring macroeconomic stability remains the key priority, as RBI cited strong domestic recovery. While Fitch retained India's growth forecast at 7% in its December edition of the Global Economic Outlook, the World Bank revised India's GDP growth forecast upwards to 6.9% from the October forecast of 6.5%. In October, the World Bank had cut India's GDP growth forecast to 6.5% from 7.5% as spillovers from the Russia-Ukraine war and global monetary tightening were weighing in on the economic outlook. However, the forecast has now been revised upwards due to higher resilience shown by the Indian economy to global shocks and better than expected second quarter numbers. Now, the Indian economy grew more than expected in the second quarter of this fiscal, owing to a large boost from domestic consumption and investments. That said, India is shielded to some extent from global economic shocks, given the domestically focused nature of its economy, with consumption and investment making up for the bulk of the country's GDP. However, it is not completely resistant to global developments, and hence the worldwide economic slowdown is expected to reduce demand for the Indian exports. Now, a GDP growth in the range of 6.5% to 7% would mean that India would still be one of the fastest growing economies within the world. So what does all of this news mean for you? The GDP forecast has been down revised by RBI, but the down revision is not from a 7% growth forecast to a 4% growth forecast. The down revision is from 7% to 6.8% only. And by the way, this still makes India one of the fastest growing economies. That being said, the 35 basis points increase in the repo rate is in line with expectations, and there was no surprise element in this announcement. Therefore, this news will have an indirect neutral impact on you. Now, despite the revisions by multiple global agencies, India's GDP growth would still be amongst one of the fastest in the emerging economies and also globally. Therefore, this will have an indirect positive impact on you. While I say this, this is Raj Mehta signing off, wishing you and your loved ones the very best.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.